Since the market is quiet, it gives us some time to look at longer term trends and get someone who is a veteran of the markets to speak with us. Let's welcome our market master for the morning, Alroy Lobo, Chief Strategist and Global Head of Equity Asset Management at Kotak Mahindra AMC. Good morning, Alroy. First of all, a very happy Christmas to you, and may the new year bring you a lot of good luck and happiness as well. Well, what have you got in terms of a strategy for 2015 itself? In the first place, do you think that after having put on 35% this year, the markets can see a gung-ho 2015?
I think we are definitely going to see, good markets for quite a few years. We do believe that India is now a multi-year story, and what you've seen in 2014 is perhaps just the beginning. Having said that, because the market has given fantastic returns in 2014, you would see perhaps more tempered returns in 2015. But any investor, even investing now in the markets, in my view, would basically generate pretty decent returns over the next few years in India. So India is a multi-year story, and we continue to be constructive on Indian equities.
Okay. Alroy, hi, good morning. Merry Christmas to you and to your entire team at Kotak Mutual Fund. When you say tempered gains, what do you mean? I mean, of course, this 35% gains looks very large to replicate. But over the next couple of years, what kind of gains do you think investors should expect from the markets?
I would say something in the region of around 15 to 18% in rupee terms is what we would expect on a compounded annualized growth rate basis, and it could be more. You would see perhaps the numbers being far more pronounced as we get into FY17, FY18, when you really see the market being led more by earnings rather than just by macro changes. If you look at the 5-year period, our view is that the first 12 to 18 months post Modi, has been a case where investors are hoping for a lot of macro changes happening, a lot of imbalances in the economy being corrected. But post that, it's going to be far more earnings led. And that's the reason we believe that when it's an earnings-led recovery, that time the re-rating in markets are pretty good, and you will see earnings numbers being upgraded, and therefore we believe that from a 5-year perspective, India should be able to generate a lot of interest from investors.
Approximately which is the quarter you expect earnings to really start shooting up?
I would say post FY16. And the reason for that is India is still growing far below its potential GDP growth rate, and we need to get that GDP growth rate up. Once a country crosses its potential GDP growth rate, that's the time when corporate India gets the operating leverage in, and the earnings numbers become far more powerful. And I don't think analysts have penciled that event into numbers. First and foremost, analysts have just about 1 or 2 years estimates. But as you get into FY18, FY19, that's the time you're going to see earnings numbers being far stronger than what you're going to see in FY15 or FY16. And when you get strong earnings growth, you also get a PE expansion, and therefore I believe that an earnings-led growth in market is going to be far more stronger for equity returns.
Okay, but FY16, all the 4 quarters you're not seeing a turn. You're only seeing after FY16, is it?
Yeah, we are looking at about 15 to 16% earnings growth. When I say that you're going to see powerful earnings growth, it could be plus 20%. Post that. So the reason being is that even in FY16, we are penciling in about a 6 to 6.2% GDP growth rate, which is almost close to potential. So you need to have a far higher GDP growth rate for that operating leverage to kick in, and that's the time you get the plus 18, plus 20% kind of earnings growth.
Okay, since we have invited you to give us your strategy for 2015, let's start off with that. In 2014, Alroy, the best performing sector by far was the private sector banks. So names like Axis, IndusInd, Kotak have risen about 70 to 100%. Do you think that will continue to outperform in 2015 as well?
Yeah, we continue to be positive on the banking sector, and in particular private sector banks. And the reason for that, it is a fantastic proxy for the economy. We do also expect monetary conditions to ease, And between private and state-owned banks, I think state-owned banks, have a lot of things to resolve. One is, getting themselves recapitalized, which itself is, an issue. And therefore, the capacity to lend has significantly shrunk for state-owned banks. So market shares will move to private sector banks. And we do believe that the asset quality, at least in private sector banks, are better managed compared to what we have seen in terms of state-owned banks. So in that context, I think the private sector banks will continue to outperform. There could be a period of time during the year when monetary conditions ease, where you will see some kind of catch up in valuations of state-owned banks. But strategically, we would still like to be with private sector banks from a medium-term perspective.
Okay. Actually, in all your funds, in many of your funds at least, Kotak Select Focus, that's one of your big funds, Kotak 50, Kotak Mid Cap, you are actually overweight on financials compared to the market weight by about 3 to 4%. Will that continue to be the strategy, or will you go even more overweight on financials?
I think we have got in the positioning pretty right. I think we will continue to maintain this kind of overweight in our portfolios. What we are doing also is basically trying to play the interest rate sensitives of sectors which will benefit from monetary condition easing. You are actually seeing in some of our portfolios that auto is one sector which we like. We think it's an early beneficiary of an interest rate cut. As far as infrastructure is concerned, we are very, very selective. We do understand that there is benefit on companies which are leveraged, but there are other issues that infrastructure segment needs to address, and unless those are addressed, we will not basically go significantly overweight that sector. So we're trying to play more the early interest rate sensitives.
Okay. What about IT, Alroy? You're slightly underweight compared to the market weight of IT in several of your funds. Will you top up on IT or remain that way?
No, I think IT, if you look at what we normally see is that it tends to do, at least large cap IT tends to do pretty well in the second half of the calendar year. And as you come to the first half of the calendar year, the returns are normally tempered, and you can see this across number of years. And the reason for that is that in the first half, there are a lot of events that market looks forward to. One is the guidance. Second is there are a lot of visa related issues and visa costs that hit these companies maybe the second quarter of the calendar year. So in that context, these stocks don't really tend to outperform. But come second half of the calendar year, and you normally see very strong performance of the IT sector. So we still like the sector. We're just sort of trying to time it more precisely. We think this is one sector which will continue to do well, and also realize that some of these companies are becoming pretty large, and therefore of a large base, it's going to be difficult for them to register very, very strong top line growth. But given where valuations are, we will take a favorable view on IT as we progress into calendar 2015.
Since you are bullish on a lot of economy-related sectors, Alroy, I wanted your thoughts on the cement space, because there was just a big deal that took place where Ultratech has bought, two of JP's most profitable cement units. How bullish would you be on this sector, and what are the pockets that you would look at to invest into now?
Actually, cement, we have been overweight in our portfolios now for quite some time, and we do believe it is a very strong proxy for the economy. It's a proxy for infrastructure. Since we are not really bullish on number of infrastructure segments, we have tried to take exposure to that segment through the cement space. We have got some well-managed companies in the cement industry. Some of them are reporting pretty decent cash flows, and we do believe that that sector will continue to do well. So we are positive on the sector, not because of acquisition-related opportunities, but because of its own intrinsic growth rates and free cash flow characteristics.
So when you talk about this 15 to 18% market growth in the next couple of years, is that penciling in reforms as well? Because on that front, things have slowed down a bit. Or are you just penciling in earnings upgrades, and on the back of that, is this 15 to 18% projection?
No, I think, during the course of the next 2-3 years, you will see reform progress. it may be slow and steady, but it's moving in the right direction. I think, there are challenges, as you know. It's very difficult to pass, make legislative changes because this government doesn't have a majority in the upper house of parliament. So I think that one has to tone down expectations as to the pace in which things can happen. But what is more interesting to note is that the government is attempting, is trying, and it's not really sitting and not really wanting to discuss these bills. So I think over the course of the next 2 years you will see some of these changes happening. There'll have to be a lot of negotiations with parties, negotiations with states to get some of these bills passed. But I think this government will be able to finally get it right. The good news is that it's moving in the right direction, and both the central bank as well as the government, in my view, are definitely not going to take shortcuts. They would like to put India on a more sustained growth path for a prolonged period of time, and therefore any step they take will be more measured, more calibrated, to make sure that we don't disturb the long-term growth rate of India.
Okay, a couple of questions. Would you say the mid-caps will outperform in, say, in the next 12 to 18 months? If yes, by what margin, if you have something in mind? And then the point you referred, what kind of rate cuts are you expecting? Will NBFCs be an important part of your portfolio?
Yeah. In fact, as far as mid-caps are concerned, our model basically states we are in a neutral zone, which means we're relatively indifferent between mid-caps and large caps in the portfolio. Last year, the model was indicating that we needed to be overweight on mid-caps. So at the moment, the model is suggesting that because of the strong outperformance, we will see more the returns more in line with what large caps could possibly give, unless you see price corrections that happen in mid-caps, which then make them once again far more attractive. As far as rate cuts are concerned, we are looking at about a 75 to 100 basis points cut over the fiscal year 2016, and we do believe we are coming closer to the rate cut.
Okay.
And please also understand that inflation numbers are clearly softening. Some of the drivers of that inflation are showing signs of weakness, so it just gives the Reserve Bank more flexibility to consider easy monetary conditions. So we are definitely looking at calendar 2015 to be the year where you will see easy monetary conditions prevailing.
All right, so since you are so bullish, Alroy, and it is Christmas, if you had to leave one Christmas gift for your viewers, I know you don't talk stocks, but you're free to give us a stock, a sector, anything.
The nearest you can come to being specific.
No, I think, like I said, we are positive on interest rate sensitives, the early cyclical recovery plays, both the private sector banks and the auto sector. And also in the consumer space, we do believe that companies which have pricing power and which benefit from the commodity price fall are sectors as companies where we have to be so focused on, because the earnings growth of these companies could be pretty strong, and that is one sector which I believe will continue to deliver strong numbers, and the quality of companies in that space are pretty good. I would basically say that at this point of time we need to see more on the ground for taking a very strong overweight position on infrastructure, and at the moment we would be relatively tempered in our weights on that sector.
Fair point. Alroy, it was a pleasure speaking with you. Thank you very much for a very rich conversation. Have a great year ahead.